Welcome back to another episode of Multifamily AP 360. And today's our guest is Justin Goodin from Goodin Development. Welcome, Justin.
Thanks for having me.
Yeah, absolutely. Thank you very much. And a little bit about Justin. Justin Goodin is the founder of Goodin Development, a multifamily development firm based in Indiana that enables busy professionals to invest in real estate without the demands of being a landlord. Justin's real estate journey began back in 2018 when he believed he was on the right path with a finance degree from a top 20 business school, a stable career as a multifamily underwriter at a bank, a 401k, and home in Indianapolis with his wife. So, with that, Justin, you want to add anything to your background?
Yeah, like you mentioned, I'm a multifamily developer in Indianapolis, Indiana today. But yeah, I didn't always start like that and took a long time to get here. So yeah, I got started in real estate by buying a single family house on the west side of Indianapolis and knew I wanted to like scale my business, scale like properties I own and move into commercial multifamily. Knew I didn't want to stay like in residential and fix and flips for forever. So I got really intrigued by apartment investing, just started doing like a ton of self-education and research of my own, which propelled me to work for a multifamily underwriter for a bank after graduation and did that for a number of years, analyzing the risk for the banks on multifamily loans, seeing how they evaluate sponsors, how they evaluate business plans, all of which was really beneficial for what I do today. And I eventually left my W-2 to pursue real estate full time, commercial real estate full time. And we've acquired in the last 5 years, 500 or so multifamily units with partners and have since moved into ground up multifamily development here in Indiana. And happy to chat about more of the reasons why we went into development and what the reason for that switch, but saw just a ton of opportunity for development here in Indiana and really excited to continue growing that space.
So yeah, definitely we'll jump into that development side. Before that, like you have stable job. So why? What is the reason behind shifting towards real estate, multifamily?
Yeah, I'm more, yeah, on the multifamily side, I don't invest in any other asset classes. I mean, for me, I just trust the growth and stability of commercial multifamily. I mean, as we're speaking now, home ownership, I think, is becoming more and more difficult for the average person to afford, which I think in return is going to force more people to rent. So I think multifamily is going to be in demand for the long term foreseeable future. On top of that, I mean, people always need a place to live. Doesn't matter what kind of economy we're in, what's going on with interest rates. People always need a place to live, which, in return, again, I think multifamily will just stay in demand for that reason too.
Yeah, absolutely. Great points. So, what kind of challenges you faced when you're doing value add multifamilies, and what is the reason behind switching from value add to development side?
Oh yeah, I mean, great question. I mean, the biggest challenge that when I was buying existing properties in the value add space is the competition. The competition is just tremendous in the existing kind of value add space. So many different companies are going after the same kind of product, which in return, I think just makes it a very competitive space, very inflated, and you are kind of like forced to get like really aggressive in your projections and your underwriting. So, I went an entire deal or an entire year without finding a deal simply for that reason. Nothing that I found would pencil out or I wouldn't win a deal from a broker. I just wasn't comfortable kind of stretching my limits and my assumptions in my model to kind of, compete against other buyers to win these deals. So yeah, competition. And I think there's just, less competition in the development space. There's, less investors willing to put up 6 and 9 months of work up front to even just get a project or start a project with that amount of time. So I think, I'll be able to grow faster and further in the development space by doing more volume simply because there's a lot less competition or, investors willing to do development.
Got it. Thank you very much. So you're saying less competition for development projects. So what factors you weigh in when you're going for development projects from market wise, sub-market wise, or financing side overall?
I guess like, how are you going to get these deals to, work in your model? For us that, we're seeing construction costs are always increasing. Interest rates right now are really high. It's in turn really difficult to get these deals to pencil out on the development side. So we found a really good competitive advantage working with different municipalities to partner with on our projects. So in return for bringing quality housing and jobs to the area with our projects, we found a way to actually partner with different cities or towns where they can invest in our projects alongside us, which in return lowers our basis, makes our projects more financially feasible for us to continue doing deals.
Got it, got it. So from investors' point of view, value add deals, you may get cash flow from, year one or day one, right? So from coming to development projects, you may not get that kind of cash flow from investors. It may take like 2 years, 3 years. So how exactly, negotiating that factors from investors' point of view?
Yeah, that's a great point. So a lot of the investors that I have worked with and talked to, I mean, they're a lot more concerned with really just like multiplying their equity faster or sooner, and not necessarily concerned with earning that 4 or 5% coupon with the cash flow. I mean, the cash flow is nice, but I guess if you don't need the cash flow, if you don't want it right now, and you're okay with waiting a predetermined set of time before you start receiving that cash flow, or we sell the project and multiply equity faster, that's like really who like a development project would be more tailored towards, is an investor that doesn't necessarily need the cash flow, but likes the idea of multiplying their equity faster. And our projects, they take around 14 months to build, so not like the 2 or 3 years down the road. They can start expecting cash flow around year two of that mark, so a little bit sooner than most people would expect.
Sure. So how financing works for ground up development projects? So what are exit criteria for your projects?
Yeah, so for us, we really enjoy working with local banks here in Indiana. We have developed an awesome relationship with a local bank here nearby. We've done 4 past projects with them, working on number 5 right now. So, I mean, for me, like local banks have been a fantastic partner in our projects. And to answer your second question about the exit, we're looking to build, lease up, and sell our projects. So at least like for us, what we're doing over here at Goodin Development, like we're not looking to hold these properties long term or hold them for 5 years, whatever, asset manage them. Our strong point is development. And I feel like anything that takes us away from that focus is kind of just taking us away from our true like strong point, if that makes sense. So for us over here, like we're looking to build and sell as soon as possible.
So what is that typical timeline, like 3 years, 4 years?
Yeah, usually project around 3 years, correct.
Okay. So financing point, what's your observation from value add versus ground up construction?
So on the value add side, you're borrowing money from a bank and they can usually finance a good portion, if not all, of your improvement costs, which could help out your leverage amount as well. On the development side, there is a tremendous amount of equity going into the project first before we even start drawing on the loan. So day one, we close on the construction loan. We're not using it until 8, 9, 10 months down the road, because we're spending all of our actual investor equity up front first of the project, building it, and then only when that runs out is when we were drawing on the construction loan. So for a good portion of the actual timeline, it's a all cash deal. We're not paying interest on the loan, really just using equity to build the project, and then once that runs out, utilizing the construction loan.
Got it. So what size of ground up development projects you are looking at this point, and what kind of submarkets, what's your criteria there picking, particular land or, projects?
Of course. Yeah, I mean, at least like for us, we're looking here in Indiana, not looking to go in other states, other places outside of Indiana. I'm just like a really huge fan of staying laser focused on one thing. And for us, that's going to be ground up Class A apartments here in Indiana. Yeah, as far as like more on the criteria, other growing markets in around Indiana, we're typically doing project between 50 to 200 units right now. So in that sort of size range, what we're sticking to. Our first project was $32 million. Our second one that we're working on right now is $26 million. And those have all been Class A apartment units, and then usually some form of commercial retail on the bottom floor. So like more of a mixed use community.
Yeah, absolutely great. And also like Midwest, they like one of the advantage with Midwest markets like Indiana and Ohio or majority states, like not much supply in last few years and next few years also, right? If you compare with
Yeah,
South,
great point.
there's a lot of supply last 2 3 years and even next year also we can expect. So that is the one advantage with you, right? So how
Absolutely.
like high interest rates, inflation, or other factors influencing overall your investment
I
strategy?
mean, the rising interest rate environment has definitely made, new deals, difficult to pencil out. Same with construction costs are, rising all the time as well, payroll costs. But, like I mentioned before, like a way we found to stay competitive and stay actively doing deals, really like no matter what's going on with the interest rate environment or the economy, even when times are bad, we can still continue doing projects. Is we found a way to partner with different municipalities. So when we're building these really high class premium products, they're not cheap. They cost a lot of money to build. This isn't something that's cheap, made of vinyl. These are a lot of brick, a lot of premium amenities, granite countertops, things like that. So very very premium apartment complexes we're building, and those things are not cheap. So in exchange for doing so, we found a way to partner with these different cities and towns and work with them to where they can actually invest alongside us. It lowers our basis. It makes the projects financially feasible so that we can continue doing projects, really no matter what's going on with the market.
So what exactly municipalities or government's contribution in these projects? So tax point of view or any other point of view?
So there's different incentives that can be used. We've used tax increment financing in the past. There's tax abatements out there. Really like there's different methods that developers can use to work with the cities. But I mean, basically, like it all just sums up to it's costing us X amount to build this project. It might only be worth this amount when we cut the ribbon, and that's strictly because the rents might not be high enough to justify the construction costs. So we're quite literally, building a project that isn't worth the construction costs. So that gap is what we call the financial gap, and that's how we work with different cities and towns to get these projects done. If municipalities are not willing to work with the developers to fill that financial gap, projects don't get done, and it's really difficult to build in an area where there's no incentive and the rents might justify or might not justify the cost to build it.
So are these located in any opportunity zones? What is the reason behind getting tax abatements?
Yeah, I mean, just another way to make the project more financially feasible for the developer. I mean, that's all a tax abatement is doing. It's sort of making their tax bill lower, which in return could help out the returns, make it more market feasible for the developer.
Sure, got it. How much it will cost for building a unit and what is your exit cost for these new constructions?
Yeah, I mean, our rough cost per door right now, as we're speaking in December 2024, strictly like on the residential side, like building the actual apartment units, we're budgeting anywhere between $175,000 to $185,000 per door,
Yeah.
and that's for very premium kind of A-class quality unit.
Yeah, I think that's common across other markets as well. So how about like new governments and also new tariffs and how exactly that will impact labor cost or material cost going?
Yeah, I mean, it's definitely gonna make it like a lot more challenging to say the least, but we just think with our competitive advantage, we'll still be able to continue doing deals and doing projects when we find a way to partner with those different municipalities.
Got it. Yeah. Thank you. And what kind of challenges you guys faced so far in new construction projects?
I mean, every day is a challenge, right? I mean, it's every day is it's kind of just managing the construction company from a high level. So, we're on site several times a week, walking the property with the construction company. We have a weekly call. So I think sort of just, like learning from a fire hose is the best way to put it. I mean, there's so many different parties and companies and things that have to come together to build a project. And as the developer, I mean, you're really kind of in charge of managing all these different parties, making things sure, things go correctly, things go on budget, on time. There's so many different like moving parts. And then as a developer, you're really kind of just in charge of, navigating those challenges to make the project successful. So I think that's like the most difficult yet, challenging part is sort of like just navigating all those different parties, make sure everything is, going according to plan.
Got it. Thank you. So what's your company's plan for next 2 to 3 years?
Yeah, so we are going to continue building, Class A mixed use properties here in Indiana, not looking to go outside of Indiana or do like any other asset classes. And I think like after 3 to 5 years, after I've had, a really good number of projects in the pipeline, I would start to reconsider bringing more companies in-house. So I'm thinking about bringing construction in-house, property management companies in-house, later on down the road. But right now, I'm really just focused on, a core concept of just building Class A apartments.
Got it. Got it. So would you share any of your best investing experience so far?
My best investing experience, I would say just like working with different, mentors and people I've had along the way that are, 10, 15 years further ahead than me. That's been the best experience, kind of just learning people that have done what you want to do and you're really kind of just, following their lead on projects and partnerships. It's a really, awesome way to kind of make your learning curve less steep and not go like through all the mistakes that they went through in the beginning.
Awesome. So would you also share any challenging experience so far?
I think like in the beginning, when you're just like getting started in real estate and people don't take you serious because you're new, you haven't had a lot of deals, you haven't had a lot of experience or track record. I found a way through social media to just gain awareness with my brand, my company. So I think that just having like multiple thought leadership platforms has like really helped me along the way and kind of like overcome that challenge. Whether that's a podcast, a meetup, a Facebook group, posting on LinkedIn, yeah, so overcome that challenge. I've just, had multiple thought leadership platforms.
Yeah, now you're very active on social media, running, big
Yeah.
Facebook group or something, right? So awesome. Any personal habits that are helping you to be successful?
So doing something at least like in the morning, some form of exercise, whether it's a, walk in the morning or going to the gym, I find that just, doing something in the morning that's physical is just a way to like clear my head, stay healthy, and prepare for the day.
Awesome. So any books that impacted you?
Yeah, I mean, Stay Sane in an Insane World. I think it's actually on my bookshelf right now from Greg Harden. Really good personal development and mindset book. Greg Harden was the coach for Tom Brady, and his book is kind of about that and principles he teaches to his students.
Awesome. So share me any one personal learning that played major role in your business or personal side.
YouTube, podcasts like this, courses online, probably just like YouTube and just different like free resources online.
Got it. So how can listeners can connect with you, Justin?
You can go to LinkedIn and just type in my name, Justin Goodin, or go to goodindevelopment.com. And on the homepage there's a free 7-day passive real estate investing one-on-one email course that you can take if you want to learn like the ins and outs of passive investing, how it works, how to get started. That free 7-day course will tell you exactly what to do A to Z.
Awesome. And thank you very much, Justin.
Thanks for having me.